Today we're going to be talking all about penny stocks, what they are, how they work, and why people love them. Coming up next. Hi everybody, my name is Dee Burks and this is Retirement Rescue, where we talk about how to make money, save money, and create your best life. Well, today we're going to be talking about penny stocks. And this is going to be a really simplified definition and explanation of what they are, why people like them, and how you can pick a good one. Now, if you like videos on finance and trading, please click subscribe, click the little bell, and you'll be notified when the next video pops up. Now, first let's talk about a really simple definition of what penny stocks are. Stocks are really stratified, differentiated, based on somewhat on price. Theoretically, price is a direct reflection of the quality or value of that company. That share price is a direct reflection of that. Theoretically. It's not 100%, but that's kind of how it goes. So when you get into penny stocks, that's usually defined as stocks that trade at less than $5 per share. That is the lowest level of stock. These particular stocks are considered highly speculative. And let's talk about why that is. In this range of stocks that are trading at, 1 penny to $5, you're going to have certain types of companies. Now, some of these companies are just brand new startups. They're just getting started. So yeah, they don't have a lot of value yet. They're just getting started. Some of these companies are companies that have actually been around a while, but they've had issues. They've either had financial issues, they've had management issues, they just haven't gotten their feet under them. Some of these companies are bad companies. I mean, they're going down hard. They've done horrible things or whatever. There's a reason they're trading at less than $5. And then some of these companies are old, sometimes blue chip companies that are in their final death knell. Companies that were old timey, 40 years ago were big companies. And now they're spiraling down and slowly going out of sight. So that's kind of the range of what's available in penny stocks. Now, when you think of stocks, the comparison I'm going to use is when you go shopping, because that's the easiest for me. Penny stocks are like a yard sale. You're going to the yard sale. Okay? Granted, most of the stuff at the yard sale is junk. Okay? But there's money to be made. Because some of that stuff has value. And you're always looking for that one thing out of 100 that has tremendous value that you can get and make money on. And that's penny stocks. They're the yard sale. Okay? Stocks that are ranging in the $5 to $10 to $12 range, those are companies that are at a little better spot. They've kind of gotten a few things going, they've had some good news, but they're still pretty volatile. They're not 100% yet, but they're getting there. They're doing some good things. That's like the dollar store. Everything's got a little bit of value, maybe not tremendous value yet, but you want to go in, you want to look for that thing that's going to really grow, right? So then you have the stocks that are in the $10, $12 range, all the way up to the $15 to $20 range. That's like Walmart. It's got a little bit better value, a little bit more to offer, more value, more things to buy, more things to look at. A little bit better value, a little bit better company. And then you got companies that are in the $20 to $30 range. That's like Target. A little bit better value, a little bit more to offer. And that's just a really quick analogy of how stock prices reflect their value. Now let's go back to the penny stocks. Let's go back to the yard sale. You're going to buy 10 things, okay? Those 10 things, you can look at it like a bell curve, a big curve. There's going to be 3 things over here that are going to be a total waste of your money and you're going to lose money on. So yeah, the odds are about 30% of your picks, especially if you're not careful, yeah, they're going to be bummers. And then you're going to have the middle, that top of that curve, okay? You're going to have maybe 4 stocks that you pick and they make some money. Maybe you even double your money. It's pretty easy for a $2 stock to go to $4. That's double your money. People love that. Happens all the time with penny stocks, especially if you do your due diligence and you get a good one. So about 4 of those will be in that range. You'll make a little bit, maybe 10%, maybe 20%, maybe 50%. It's great. Okay? And then there's going to be these 3 over here. These 3 over here are going to be the stocks that you pick that are, when they're in penny stock territory, that end up being worth $20 a share, $50 a share down the road. They're going to be the stocks where the company gets bought out and the share price goes from $2 to $50 overnight. They're going to be the stocks like Amazon. Amazon used to be a penny stock. Back in 1997, when Amazon did their original IPO, their stock price was $1.73. Oh gosh, to have 10,000 shares of that now. And they stayed in penny stock range for about a year. And for those of you who recall, that was during the buildup of the dot-com bubble. And they were involved in the dot-com bubble. So they skyrocketed. That penny stock, in about 3 years, a little under, about 3 years, it broke $100. It went from $1.73 to over $100. And then it crashed down hard. And that is something you need to understand with penny stocks. They may have a meteoric rise on occasion, but they come down hard because they are so volatile. There's nothing wrong with that as long as you understand it going in. Now, smart people would have sold it when it started to come back down and taken their money. And then when it hit bottom, and it hit bottom at about $6, just over $6, they would have bought more. And that is a good way to look at penny stocks, because when they come crashing down, odds are they're going to go back up with good news, and they'll go up tremendously. Well, Amazon did just that. Amazon is now trading about $3,400 a share. That would have been a tremendous investment. And it's easy to say after the fact. But Amazon was one of those companies you had a lot of hints along the way they were going to be good. You could have bought them at $1.73. You could have bought them at $6. You could have bought them at $10. You could have bought them at $20. You could have bought them at $100, all the way up. There was plenty of time to hop on that wagon. And a lot of people did. But those people who understood what Amazon had to offer and who watched them the whole way and bought stock the whole way, they benefited the most. That is why people look at penny stocks. Now let's look at how you pick a good one. Anyone who watches my channel knows that I tend to favor tech and biotech stocks, and there's a big reason for that. Tech and biotech stocks tend to be those companies that are trying to create a product or a procedure or a piece of equipment they can patent. Patents are incredibly valuable intellectual property that people create from nothing. They're those people working in their garages, like the original Microsoft or Apple or even Jeff Bezos. You know, he started Amazon, a little office by himself. You know, those are the people and those are the ideas that have the most promise because they're creating something of incredible value from nothing. So I want to look at companies that are creating things that are patentable. That's my choice. Doesn't have to be yours, but it's mine. And I like biotech because I'm really familiar with medicine. I like technology just because I think it has so much promise. So that's it. There's no other reason other than that. So when I look at a little company and I want to see them doing cool stuff, I want to see them doing things that are market disruptive. They're not just doing the same old that other big companies are doing or that other competitors are doing. They are doing something disruptive. Now let's think about the biotech world. So there's really 2 things here. I want them to be doing something different than everyone else is doing. They're not just doing, vaccine number 83 for the same disease. Everybody's doing that. I want to see them doing something different, but also something that has a large market. For example, let's say company A is developing a treatment or drug or whatever for a really rare disease that only 500 people in the world have. I'm not going to invest in that because the market is limited. Not that it's not a good idea, not that someone shouldn't do it. Yeah, they should. But as an investor, I want to see a bigger market. So I'm going to look at the companies that are doing things differently, but are looking to treat or to solve large problems. They're doing treatments that are a little bit out of the box for diabetes. They're doing treatments to try and cure or replenish lung tissue. Huge application. There's a couple of companies that I'm looking at that are doing things in the lung regeneration or lung healing sort of areas, just because it has such a huge market. And so I'm interested in those sorts of things. So there are several different things that I look at. I want them to be disruptive. If you were in retail, you would look at someone like Shopify or Square. They're doing things differently. They're disruptive. Those are much bigger companies right now, but you would look for a small company that was similarly disruptive. They're doing something different. When Amazon was little, they were doing something different. They were doing just books, and they were starting to get into ebooks. I remember in the late 90s, Jeff Bezos went and talked to a big group of publishers. They laughed at him and his ideas. A lot of them are out of business now, by the way, because he put them out of business. So you want to look at those people that are doing things that seem a little different. Like if you're in the energy sector, maybe instead of looking at companies that are doing solar or wind, you're looking at companies doing hydrogen, like Plug. You're looking at companies that are doing devices, that are doing delivery systems, that are doing software solutions. A great thing I also look at are little companies that are doing things for big companies. They're providing services, or they're providing a key component for Apple, for Tesla, for any of these large companies. The reason being, they're prime takeover targets for those companies to buy them out, and your stock price will zoom up. They have a huge market with these companies, with an Amazon, with a Tesla. It's a huge market. So you want to be looking at those sorts of companies. You want to look at their potential. Now let's talk a little bit about their financials. As many of you know, I'm not a super mathy person, so I don't get heavily into their financials. But there are a few things that I really look at in tiny penny stock companies. The very first one is zero to no debt. I am not a fan of debt for little companies. You think of them like a person. Someone who does not have debt or doesn't have a lot of debt compared to their size is way more flexible. When things go bad, they can still survive it. In a little company, if you have debt up to your eyeballs, one thing goes bad and you're toast. And there's always that one thing. I also look for companies that, relative to their size, don't have a ton of shares out. What that means is, if their stock price climbs a little bit, they can issue more shares. That is access to capital without having to take on debt. That's a great thing. So I look for both of those things, because when you're looking for a takeover target as a larger company, you're also looking for those things, and so it makes them a really good prospect. It gives them lots of options if things go south. It gives them lots of ability to access capital should they need it. And it allows them to look great for a company that maybe could take them over, which as an investor, that's great. So that's how I evaluate penny stocks. As a percentage of my portfolio, it tends to be less than 20%, 20 to 25%. But a lot of these stocks are like $2. You can buy 1,000 shares. You can buy 100 shares. You can buy, you can buy quite a bit of shares and just let them sit there. I don't day trade or really swing trade penny stocks. A lot of people do. There's nothing wrong with that. I just don't. I like to use the stocks that are in the $10 to $20 range for that. That's my preference. Nothing wrong with the way other people do it, but we'll talk about that on another video. But I hope you've liked this video on penny stocks. If you have questions on penny stocks, please drop them in the comments, and I'll see you next time.